I want you to picture something very specific right now. Imagine you walk into your local coin shop. It's, one of those places that smells like old paper and dust, maybe a little bit of anxiety. You're holding a single 1-ounce gold coin. Let's say it's an American Eagle or maybe a Buffalo. You put it on the glass counter and you ask the dealer, how much is this worth right now? If I wanted to buy this from you today, what is the price?
Well, based on the spot price in London or New York, he's going to punch a few numbers into a calculator and tell you it's roughly $4,800, give or take the dealer's premium, of course.
Right, $4,800?
Mhm.
That is the reality we live in. That is the price discovered by, millions of traders, central banks, and algorithms fighting it out every millisecond in the global markets. That's the real price.
It is the market price, yeah. It's what you pay to acquire the asset.
Exactly. But here is where it gets really weird and honestly a little bit infuriating. If you were to take that exact same coin, walk past the coin shop, fly to Washington, D.C., and somehow get a meeting with the United States Treasury, and you ask them, hey, Madam Secretary, what is this coin worth on your official books?
Do you know what they would say?
They definitely wouldn't say 4,800.
No, they would look you dead in the eye and tell you it is worth $42.22.
Which is quite a spread.
A spread. It's a hallucination. $42. That sounds like a joke. It sounds like a clerical error from a century ago that someone just forgot to fix in an Excel spreadsheet because they lost the password. But it's not an error, is it? It is definitely not an error. No, it's statutory law. Specifically, it stems from a statute that was finalized back in 1973, Public Law 93-110, if you really want to look it up. And that massive discrepancy, the gap between the $4,800 the market pays and the $42.22 the government claims it's worth, that is arguably the biggest lie in modern finance.
It feels like Enron-level accounting. I mean, really.
It looks that way. It really does. But, and this is the crucial part we're going to unpack today, it is also a trapdoor.
A trapdoor.
A trapdoor that the Federal Reserve and the Treasury can open to escape what everyone thinks is a mathematical impossibility.
Okay, let's pause and zoom out for a second. Because when you say mathematical impossibility, my ears perk up. I'm looking at the terminal right now. The U.S. national debt has climbed to $38 trillion. I talked to my guys on the bond trading desks, and the prevailing narrative is just absolute doom. The fear isn't recession anymore. The fear is just arithmetic.
Right. They're running the numbers on interest payments, and they see it consuming all the tax receipts.
Exactly. The common wisdom is that the U.S. is bankrupt, that paying this back is impossible without turning the dollar into confetti or having a total societal collapse, a Mad Max scenario where we're trading cans of beans for ammo. People feel trapped by this narrative.
And that is the desire loop a lot of people are stuck in. They feel crushed by the U.S.'s bankrupt story. They see the debt wall, they see the deficit, and they assume the only end game is ruin. They are desperately looking for an exit that doesn't involve, living in a bunker.
And that's where this $42 gold price comes in. Because to me, it just looks like the government is incompetent at bookkeeping. How does undervalued gold save us from a $38 trillion debt wall?
It's the nuclear option. It's a mechanism buried deep in the Federal Reserve's accounting manual. It's a legal trick, though, they would call it a policy tool, that allows the government to execute what we're calling a gold reset.
A reset. That word gets thrown around a lot in, the dark corners of the internet.
It does, but I'm using it in a very, very technical sense here. The government has the legal authority to change the price tag of their gold from $42 to, say, $30,000 per ounce overnight.
$30,000.
Or $20,000.
Okay.
Or $50,000. The number really depends on the math they need to solve. But the thesis we're looking at today suggests a jump to something like $30,000. And the result of that move, it would instantly wipe out trillions of dollars in debt without the Treasury having to sell a single ounce of gold.
Okay, stop. Stop right there. That sounds like a conspiracy theory. That sounds like one weird trick to fix the economy, clickbait. You're saying you can just wave a wand, change a number on a piece of paper, and the debt problem vanishes.
It sounds like a conspiracy theory because it's obscure. It sounds too good to be true, but it is not a theory. It is a documented legal mechanism. And more importantly, we have done it before. We absolutely have. It happened in 1934 under FDR. It happened effectively in the early 70s. This isn't science fiction. It's history. And it's accounting.
All right, I'm listening. But I am very skeptical. I'm a macro investor. I care about what this does to the dollar, to my portfolio, to the bond market. If this is real, Why isn't everyone talking about it on CNBC? Why isn't the Wall Street Journal running front-page stories on the $30,000 solution?
Because it's boring. Until it isn't. It's buried in balance sheet mechanics that most analysts just gloss over because they assume the status quo will last forever. But to understand it, we have to start with the asset itself. We have to look at what the United States actually
The
owns.
secret asset.
Exactly. So let's do a quick inventory check. The United States officially owns approximately 261 million ounces of gold.
Which is the largest stockpile in the world, theoretically.
Theoretically, yes. We do have to trust the audits, but let's just assume for a moment it's there. It is stored primarily in the bullion depository at Fort Knox, at West Point, and some at the Denver Mint. Now, if you take that 261 million ounces and you value it at the current market price, let's just say around that $4,800 mark, that hoard is worth over $1.2 trillion.
Okay, let's run the math on that. 1.2 trillion is a lot of money. If you gave me 1.2 trillion, I'd be having a very, very different day. But against a $38 trillion debt, that's what, like 3%?
It's a drop in the bucket, it really is.
Exactly, it's a rounding error. Even if we sold all the gold, empty Fort Knox, sold every last bar, it pays the interest on the debt for maybe, what, a year? So how does this save us? The math doesn't work at market prices.
That is the right calculation if you are marking to market. But the government doesn't mark to market. This is the bookkeeping fiction. We need to do a deep dive into that statutory price I mentioned earlier. On the government's official books, that gold is not listed at 1.2 trillion.
Right, because of that 1973 rule.
Correct. It's actually a fascinating little bit of legal debris. Back in the early 70s, the Bretton Woods system was collapsing. Nixon closed the gold window in 71. But they needed to set an official price for legal reasons, mostly for dealings with the IMF, so they changed the par value a couple of times, first to $38, and then in 1973, Congress passed Public Law 93-110, which set the price at $42.22222 per fine troy ounce.
4 decimal places, real.
Bureaucracy loves precision, even when it's precision in fiction, and that law was just never repealed. It just sits there like a fossil. So if you look at the consolidated financial statements of the United States government today, the line item for gold is roughly $11 billion.
11 billion. That is absolutely absurd. Elon Musk could buy the entire U.S. gold reserve out of his petty cash account if that price were actually real.
Precisely. They are sitting on a mountain of wealth, arguably the most important strategic asset in the global financial system, but they are valuing it like it's scrap metal. It's an accounting anomaly. But here is the policy wonk perspective. This undervaluation is the key leverage point. The gap between that $11 billion book value and the potential market value or a new statutory value, that's where the magic happens.
Okay, I'm trying to wrap my head around this. They have this asset on the books for pennies. So how do they turn that accounting error into actual cash that pays off bondholders? Because my mortgage company doesn't care what I think my house is worth. They care about cash. If I tell them, hey, my house is worth $1 billion in my heart, they still want the check.
And this brings us to the mechanism, and we have to do a little monetization 101 here. We need to define the roles very carefully because people confuse the Treasury and the Fed constantly, and in this specific magic trick, the distinction is everything.
Okay, let's clarify. So the Treasury is the government department. They collect taxes, they pay the military, they pay the bills. The Fed is the central bank. They manage the money supply and interest rates.
Correct. And crucially, the Treasury cannot print money. That is the Federal Reserve's job. The Treasury can only spend what it collects in taxes or what it borrows by selling bonds. However, there is a third way, a trapdoor that hasn't really been used in a long time. The Treasury can issue gold certificates to the Federal Reserve to get cash.
Gold certificates. This sounds like something from a Western movie. Are we talking about like actual physical pieces of paper?
We absolutely are. Well, historically, they were very physical. Series 1934 gold certificates. They look like standard banknotes, but they have these bright orange backs instead of green. And they come in denominations up to $100,000.
A $100,000 bill.
With Woodrow Wilson's face on it, yeah. You and I can't own them. They're illegal for private citizens to hold. They are used exclusively for transfers between the Treasury and the Federal Reserve.
Okay, so let's walk through the plumbing here. What is the current state of these certificates? Where are they now?
Right now, the Federal Reserve holds certificates for that gold. The Treasury gave the Fed a piece of paper decades ago that says, this represents X amount of gold, and the Fed gave the Treasury credit in their checking account. But those certificates are valued at the old $42 price.
Okay, so the Fed gave the Treasury roughly $11 billion way back when for these certificates.
Right. The Fed holds the paper, the Treasury holds the gold. Now, let's walk through the hypothetical scenario, the gold reset. Step one, Congress or the president. And there is some legal debate on who exactly pulls the trigger, but the Gold Reserve Act of 1934 gives the Secretary of the Treasury immense power here, passes an order declaring that the statutory price of gold is no longer $42, it is now $30,000 per ounce.
Just like that, they just write a new number on a piece of paper.
Just like that. It's a fiat declaration. Gold is now $30,000.
Hold on, stop. You're telling me, with a straight face, that the Secretary of the Treasury can just wake up on a Tuesday, grab a Sharpie, cross out $42 and write $30,000. That sounds illegal. That sounds like something a crypto scammer does right before they go to prison.
It does sound like a scam, doesn't it? If a CEO did this to their inventory to juice the stock price, the SEC would be kicking down their door within the hour. But the government operates by a different set of physics. They make the laws.
Okay, so step one. They declare gold is worth 30 grand. What happens next?
Step two. The Treasury prints new gold certificates reflecting this new price. They are, in effect, revaluing the asset on their books.
Okay, so they write up a new certificate, maybe a digital one this time, or maybe they literally dust off the printing press that says, hey, Fed, that gold we have in the basement, it's not worth 11 billion anymore. It's worth, what's the math on 261 million ounces at 30 grand?
It comes out to nearly $8 trillion. 7.8 trillion, roughly.
$8 trillion. That is a staggering amount of money.
Step three. The Treasury hands these new certificates to the Fed. Now, here is the critical transaction. The Fed must accept them. The Fed then updates its computer ledger, its balance sheet. It essentially buys the revalued certificates. And how does it pay for them? It credits the Treasury's checking account, the Treasury general account, with the difference.
So the Fed just types some zeros into a computer, and the Treasury's account goes from near zero to $8 trillion.
Yeah.
Instantly.
Instantly.
And the Treasury can then use that money to pay off debt.
Yes. They can call in bonds, they can pay Social Security, they can fund the military. It is spendable cash. It is indistinguishable from tax revenue.
Wait. So they essentially printed $8 trillion.
Technically, no. And a policy wonk would argue this distinction matters even if it feels like semantics. They mark to market. The gold never left the vault. The asset didn't change. The number of ounces didn't change. Only the price tag changed. They realized the unrealized gains on an asset they already owned.
That feels like the ultimate semantic loophole. We didn't print money, we just realized gains. But the effect is the same. There is $8 trillion of new liquidity in the system that wasn't there 5 minutes ago.
The effect on liquidity is the same, yes. But the legal justification is different from what we call printing money out of thin air, like quantitative easing.
Yeah.
QE is buying debt with new money. This is monetizing an asset you already own.
This sounds like cheating.
Yeah.
It really, really does. If I did this, I'd go to jail. Officer, I didn't forge a check. I just revalued my toaster to $1 million and then borrowed against it.
It does sound like cheating. But let's try to make it real for the listener. Because while the scale is just absurd, the mechanic is actually very similar to something millions of Americans do every day. It's the HELOC concept.
Home equity line of credit. Okay.
Right. So let's look at the house appraisal scenario. Imagine you, the listener, bought a house back in 1973. You paid $42,000 for it.
Okay. Nice little split level in the suburbs. Shag carpet, avocado green appliances, the whole deal.
Exactly. Fast forward to today. Because of massive inflation, neighborhood development, currency debasement. Let's just say that house is now worth $30 million. Just an extreme example to match the gold spread.
I am loving this hypothetical real estate market. I'm rich.
You are asset rich. But here's the problem. On your personal balance sheet, in your own mind, and on your old tax forms, you still list the house at the price you paid, $42,000. Meanwhile, you have massive credit card debt. You have student loans. You have medical bills. You look broke on paper because your debts are high and your cash is low.
Right. I'm technically insolvent because I'm ignoring the massive value of the house I'm living in.
Yeah.
I'm eating ramen noodles in a $30 million mansion.
Exactly. So what do? You don't want to sell the house. You need a place to live, right? The U.S. government doesn't want to sell its gold. It's a strategic reserve. So you walk into the bank and you ask them to appraise the house at the real market price. You say, look, this isn't a $42K shack. This is a $30 estate.
And the bank sends an appraiser. They agree. And suddenly I have access to all that equity.
The bank sees the massive equity, $30 million minus the original $42,000, and they give you a line of credit against it. You take that cash and you pay off your credit card debt.
And I'm still living in the house. I didn't sell it.
You didn't sell the house, you didn't move, you just unlocked the equity that was already there but was, unrecognized. That is exactly what the Treasury does when they revalue gold from $42 to $30,000. They are unlocking the equity in Fort Knox to pay off the national credit card.
That actually makes sense. It's terrifying, but it makes perfect sense. It's a balance sheet restructuring. But here's the difference. When I get a HELOC, the bank is giving me money that already exists in the economy. They're lending me existing capital. When the Fed does this, they are creating new money to fill that account.
That is the key difference, and that leads directly to the consequences. But before we get to the fallout, because the fallout is significant, I just want to emphasize that we aren't just guessing this could happen. It's not a theory cooked up in a Reddit forum. We have the receipts.
You mentioned FDR earlier. 1934.
1934 is the big precedent. We have to look at the context. Imagine the scene. It's 1933, the Great Depression, the banking system has totally collapsed. Deflation is just destroying the country.
Deflation means prices are falling, right?
Yes, which sounds good when you're buying groceries, but it destroys an economy because your debt stays the same while wages and prices drop. It becomes impossible to pay back your loans. Everyone was hoarding gold because they didn't trust the banks.
So FDR needed to cause inflation. He needed to devalue the dollar to make all those debts easier to pay.
Exactly. He needed to break the psychology of hoarding. So what did he do? First, he issued Executive Order 6102. He confiscated the gold from private citizens.
Which is the part everyone remembers. The government came for the gold.
Right. But the reason he confiscated it was for step 2. He couldn't revalue the gold while the citizens held it because then the citizens would get the profit. He needed that profit to go to the government. So once the government held all the gold, he immediately passed the Gold Reserve Act of 1934, and he changed the official price of gold from $20.67 to $35 an ounce.
That's a huge jump for back then. That's almost a 70% increase.
It's a massive devaluation of the dollar. The dollar lost 40% of its value overnight against gold. And why did he do it? To create a book profit. That revaluation created nearly $3 billion in paper profit for the Treasury, which back then was a colossal amount of money.
$3 billion in 1934 is like, what, hundreds of billions today?
Oh, easily. And they used that money to fund the Exchange Stabilization Fund. They literally found money to stimulate the economy simply by changing the price tag of gold.
So when people say the government is broke, they're ignoring the fact that the government sets the rules of the game. They can just change the definitions whenever they want.
Correct. And it happened again, in a way, during the Nixon shock era in the 70s. That's when we got the revaluation to 35, then 38, then the current $42.22. The pattern is clear. Governments revalue their reserves when the debt burden becomes unsustainable.
And $38 trillion certainly feels unsustainable.
Mm-hmm.
So the question for 2026, or whenever the next big crisis hits, is history about to rhyme again?
That is the question, and it leads us right to the why not debate.
Right. If this is so easy, if you can just mark the gold to market and poof, $8 trillion appears, why haven't they done it already? Why are we suffering through debt ceiling fights and government shutdowns and politicians arguing over pennies? Why wait until the debt hits $38 trillion?
Because while it solves the math problem, it creates massive trust problem.
The broken dollar admission.
Think about what it signals. If the U.S. government officially declares gold is now worth $30,000, what are they really saying to the world? They are implicitly admitting that the dollar has collapsed. They are saying, we cannot pay our debts in the old dollars. We have to cheapen the currency to survive.
It's a default. I mean, it's a soft default, but it's a default. You're paying back bondholders with watered-down currency.
It is an explicit devaluation. It tells the world, it tells China, Europe, Saudi Arabia, that the U.S. dollar is worth significantly less than it was yesterday. It tells them that the U.S. government manages its finances by manipulating the unit of account. Just like under FDR, the dollar would lose massive purchasing power relative to hard assets.
And let's talk about inflation. I asked about printing money earlier. If you inject $8 trillion into the system, even if you want to call it equity, that money has to go somewhere.
It is highly inflationary. It is a massive liquidity injection. If the Treasury uses that $8 trillion to buy back bonds, that cash goes to the bondholders, the banks, the pension funds, foreign governments. They now have cash. They are going to spend it or invest it.
So the devil's advocate view and the view of every single person listening who buys groceries is, Want a loaf of bread, cost $50.
That is the risk. The trade-off is this. You avoid a sovereign debt default. You avoid the U.S. government saying, we can't pay, which would crash the entire global banking system. That's the bankruptcy scenario. But the cost of avoiding that bankruptcy is sacrificing the value of the currency. You
Yeah.
save the system, but you crush the saver.
So you save the bond market, but you kill the dollar's purchasing power.
Mm.
It feels like we're choosing between a heart attack and cancer.
That's a grim analogy, but it's pretty accurate. It's a transfer of pain.
Okay, so let's pivot to the so what for the listener. Because I'm sitting here thinking about my own portfolio.
Mm.
I'm thinking about the listeners who have followed our deep dives on wealth preservation strategies. If I have gold in my safe physical gold, not paper, and the government does this, what happens?
This is the front-running the reset strategy.
Does the government come and take my gold? Like FDR did. That's the fear everyone has. If they revalue it, they'll want mine too.
That is the biggest fear. But we have to look at the mechanics. In 1934, we were on a gold standard. The money supply was limited by the amount of gold the government held. To print more money, they needed more gold. They had to confiscate it to expand the monetary base.
Right. But today, we're in a completely fiat system. They can print as much paper as they want.
Exactly. They don't need your physical gold. They have plenty of paper. What they need is for the price of their gold to be higher to balance their books. They need the valuation, not the metal.
So they don't need to kick down my door. They
Right.
just need to change the math.
Correct. And here's the mechanism of price action. If the Federal Reserve and the Treasury set a floor price or a bid price at $30,000.
Meaning the government says, we value gold at $30,000 and we will buy gold at $30,000.
Then who in the open market is going to sell gold for $4,800?
Nobody. If the Treasury says it's worth 30 grand, I'm not selling mine to a dealer for 5 grand. I'd be an idiot.
Exactly. It's just arbitrage. The market price will violently chase the official price. If the US dollar is devalued by that magnitude, the price of all hard assets, gold, silver, real estate, commodities, reprices upward to reflect the new, weaker dollar.
So this is the ultimate bull case for hard assets.
It is. It represents a massive transfer of wealth. Wealth moves from those holding paper dollars, bonds, savings accounts, to those holding real assets. If you're holding bonds, you get paid back, but the money you get is worth way, way less. If you hold gold, the purchasing power of your asset is preserved or even multiplied.
So the strategy here, and again, not financial advice, but looking at the macro chessboard, is that this is the break glass in case of emergency plan for them.
Right. They won't do this while the stock market is at all-time highs and the bond market is stable. Why would they? It's too disruptive. It upsets the geopolitical order. But
But if the bond auctions start to fail, if nobody buys U.S. debt, if rates spike to 10% and the whole system faces a liquidity crisis.
then all options are on the table. And this option, revaluing the gold, is the one that is legally possible, historically precedented, and frankly, mathematically efficient. The smart money move is positioning before the revaluation happens. Because once the announcement is made, that gap closes instantly. You can't buy insurance after the house is already on fire.
That is a very sobering thought. We're talking about a move that saves the government but fundamentally changes what money means for the rest of us.
It changes the denominator. It completely changes the ruler we use to measure value.
So let's wrap this all up. We've covered a lot of ground here. The magic trick is essentially an accounting maneuver. Debt is high. Gold is legally undervalued at $42. The government revalues gold to $30,000. They print new certificates. Treasury gets $8 trillion in cash. Debt gets paid out, but the dollar gets completely devalued.
That is the flow. It fixes the balance sheet, but it admits the system is broken.
It's the final Hail Mary. And it leaves me with one really provocative thought I want to throw out there for everyone listening.
What's that?
We've been talking about gold, the shiny yellow metal, the ancient store of value, but we live in a digital age. If the U.S. government sets the price of gold to $30,000 to save the dollar, what happens to the price of Bitcoin?
That is the trillion-dollar question, isn't it?
Does it crash because the government has launched a competitor? Does the government try to ban it because they need a monopoly on hard money? Or does it follow gold to the moon as the ultimate anti-fiat asset? I mean, if they could rewrite the value of their money overnight, maybe the only safety is in money they can't rewrite.
It forces you to define what money actually is. When the rules can be changed by a signature, you have to know where you stand. If gold is the king, Bitcoin might just be the rebel alliance. But in a reset, all hard assets likely move together against the dollar.
Exactly. Something to mull over. We are living through history, folks. If you want to understand more about protecting your wealth in a reset, make sure you check out our deep dive into wealth preservation strategies. We go into the specifics of allocation there. But for now, thanks for joining us on this dive into the rabbit hole of Federal Reserve accounting.
Always a pleasure to look at the books.
See you in the next deep dive.